The knowing-doing gap, the battle of the mind. Knowledge in the financial markets is remarkably cheap. In the modern era, information is everywhere. You can spend hundreds of hours studying price action, mastering supply and demand zones, and backtesting complex mathematical indicators until your strategy looks perfect on a spreadsheet. Yet many traders find themselves completely frozen or acting impulsively the moment a real trade goes live. This phenomenon is known as the knowing-doing gap. It is the psychological chasm where your intellectual understanding of a strategy is violently hijacked by your biological survival instincts the moment you transition from theory to risk. The primary reason for this gap is that the human brain is not naturally wired for the statistical uncertainty of the markets. When real capital is at stake, your brain's primary survival center, the amygdala, no longer sees a candlestick chart as a series of neutral data points or information. Instead, it perceives the fluctuation of price as a direct threat to your financial security, your ego, and your social status. This is a biological amygdala hijack, a state where the emotional part of your brain overpowers the prefrontal cortex, the area responsible for logic, planning, and following a set of rules. This neurological conflict leads to two distinct, painful behaviors. Paralyzing hesitation. You see a valid setup that meets every single one of your criteria, but you cannot bring yourself to click the button. You look for one more confirmation that never comes, only to watch the price hit your target without you. Reckless panic. Once you finally do enter a trade, the slightest move against you feels like a physical attack. This leads to a frantic desire to exit now to stop the pain, even if the trade is still technically valid within your plan. Closing this gap is not about learning a new technical indicator or finding a faster entry method. It is the first and most difficult step toward professional mastery because it requires you to rewire your biological response to risk. You must move from a state of emotional reactivity to a state of disciplined execution, acknowledging that the person who knows what to do and the person who actually executes the trades must become one and the same to survive. The 3 brutal patterns of self-sabotage. Most traders do not fail because of a flawed technical strategy. You can have a system with a 70% win rate and still go broke if you are trapped in the 3 destructive behavioral loops that systematically drain both your financial capital and your psychological confidence. These patterns are the hidden tax that the market collects from every amateur before they are allowed to turn professional. 1. Strategy hopping, the illusion of the Holy Grail. This is the most common trap for those stuck in the painful phase. The amateur trader treats trading like a search for a magical secret rather than a game of probabilities. The moment a system hits a normal statistical drawdown, perhaps 3 or 4 losing trades in a row, the trader assumes the market has changed or the system is broken. Instead of trusting the back-tested data, they abandon the strategy in search of a new indicator, a different time frame, or a trendier guru. By doing this, they ensure they never stay with one method long enough to actually see the mathematical edge play out over a large sample size of trades. They remain forever trapped in a permanent learning phase, constantly starting over from zero and never reaching the execution phase where real wealth is built. 2. Moving stop losses, the fear of being wrong. This pattern is driven by a deep-seated ego issue where the trader fears being wrong more than they fear losing money. As price approaches their stop loss, the biological fight or flight response kicks in. Instead of accepting the exit, the trader begins to rationalize, telling themselves they are simply giving the trade room to breathe, or that the price will surely bounce off a nearby level. They click and drag the stop loss further away, effectively turning a small, controlled business expense into an uncapped liability. This behavior destroys the risk-to-reward ratio that the strategy was built on. In a single afternoon, one widened stop loss can wipe out the profits from 2 weeks of disciplined work, leading to a catastrophic account-killing event that is entirely avoidable. 3. Revenge trading, the ego's final stand. Revenge trading is the ultimate act of self-sabotage. It typically occurs immediately after a frustrating loss or a series of unfair market moves. In this state, The ego takes full control of the mouse, and the prefrontal cortex, the part of the brain that follows rules, shuts down. The trader is no longer analyzing data, they are seeking justice. This leads to over-leveraged positions, often double or triple the normal size, fueled by a desperate emotional need to make the money back and prove the market wrong. In this single afternoon of madness, a trader will take low-probability setups with maximum risk, ignoring every rule in their plan. Revenge trading is the #1 cause of blown accounts, as it turns the professional business of trading into a high-stakes gambling addiction where the house always wins. The identity shift, becoming the professional. To exit the painful phase, you must undergo a fundamental identity shift that redefines your entire relationship with the market. Most traders are stuck because they identify with their P&L statement. When the account is green, they feel like a genius. When it is red, they feel like a worthless failure. This emotional roller coaster is the hallmark of the amateur, and it makes long-term success impossible because it keeps you in a state of constant psychological instability. In contrast, the professional trader identifies entirely with their process. They have detached their self-worth from the outcome of any single trade and attached it instead to their ability to follow a plan. In this new identity, success is no longer defined by whether a specific trade made money, but by whether that trade was executed according to the predefined rules. A losing trade that followed the plan is a successful trade. A winning trade that broke the rules is a failed trade and a dangerous omen of future losses. To make this shift, you must stop being a predictor and start being a casino operator. The predictor believes they can guess what the market will do next. They seek certainty, and when they are wrong, their ego is bruised, leading to hesitation and revenge trading. The casino operator understands that while the house might lose a single hand of blackjack, a single trade, their statistical edge is a mathematical certainty over a sample size of 1,000 hands. The operator doesn't care about one trade, they care about the law of large numbers. When you adopt the identity of the operator, you realize that you are not actually trading the market, you are trading your own discipline. The market is merely a provider of random data points. Your job is to stand at the edge of the market and wait for the specific pattern that gives you a slight mathematical advantage. By surrendering the need to be right about the next move, you gain the power to be consistent. You move from the stress of a gambler to the calm of a businessman who knows that as long as the process is followed, the profit is inevitable. Emotional mastery, the path to neutrality. Mastery in the markets is not the total absence of emotion. That is a dangerous myth that leads traders to suppress their feelings until they eventually explode in a moment of self-destruction. Real emotional mastery is the neutralization of emotion's impact on your physical actions. You will still feel the sharp sting of a loss and the addictive rush of a win, but you must reach a state of emotional detachment where those internal signals do not travel down your arm to your mouse-clicking finger. To achieve this, you must reframe your relationship with losing. True professionals treat losses as a simple, unavoidable business expense. Think of a restaurant owner. They do not go into a deep depression when they have to pay for electricity, rent, or spoiled inventory. They understand that these costs are the price of admission for the opportunity to make a profit. In trading, your stop losses are your spoiled inventory. By accepting that risk is inherent and that uncertainty is the only constant in the market, you strip the price action of its power to trigger your biological fight-or-flight response. The ultimate goal is a state of calm execution. You can identify this state by monitoring your physiological markers during a live trade. The steady pulse. Your heart rate should remain the same whether you are in a trade or sitting on the sidelines. If your pulse quickens as price nears your target or stop, your position size is likely too large for your current level of mastery. Mental clarity. Your mind should remain clear and objective. You aren't hoping for a bounce or praying for a breakout. You are simply observing the data. Outcome independence. You reach neutrality when the result of a single trade has zero impact on your mood for the rest of the day. By achieving neutrality, you stop negotiating with the market. You no longer feel the need to be right, and you no longer feel the need to get even. You become a silent observer who executes with the cold precision of a machine, regardless of whether the current trade is moving toward your profit target or your stop loss. This emotional void is where professional consistency is born. The Survival Checklist. Tactical Constraints. Survival is the only objective during the painful phase. In this stage of your journey, your goal is not to make a killing, it is to simply stay in the game. If you can protect your capital and keep your psychological confidence intact while your mind catches up to your technical knowledge, you will eventually win. Professionalism is built on a foundation of strict constraints that prevent the amateur side of your brain from causing irreparable damage. Use the following survival checklist as your daily operational mandate. 1. Cut position size by 50%. The quickest way to neutralize emotional pain is to lower the financial heat. You must immediately reduce your risk per trade until the dollar amounts no longer trigger a physical stress response. If your heart rate quickens, your palms sweat, or you find yourself staring at every tick of the candle, you are trading too large for your current level of mastery. By cutting your size in half, you move from a state of survival panic to analytical observation. This allows you to focus on the quality of your execution rather than the fluctuation of your balance. 2. Limit to 2 trades per day. Overtrading is a slow poison that disguises itself as hard work. In reality, it is usually a manifestation of greed or a desperate need to be active. By forcing a strict limit of only 2 trades per session, you create an environment of extreme selectivity. You stop chasing mediocre patterns and start waiting for only the highest probability setups that perfectly align with your edge. This constraint prevents the overtrading spiral where a single losing morning leads to 10 more low-quality trades in an attempt to get even, usually resulting in a massive drawdown. 3. Mandatory emotional journaling. You are required to write down exactly how you feel before you click the buy or sell button. This is not a suggestion, it is a professional requirement. You must document your internal state. Are you feeling calm and detached, or do you detect even a hint of desperation, FOMO, fear of missing out, or euphoria? If you are trading because you need to make money today, or because you are bored, or because you saw someone else on social media winning, you are gambling. If your journal reveals an emotional charge, your professional obligation is to close the platform and walk away from the desk immediately. 4. The 24-hour cooling rule. Losses are part of the business, but they can be psychologically destabilizing. You must implement a rule where you never increase your risk, add to a losing position, or change your overall strategy until at least 24 hours have passed since your last losing streak. This cooling-off period ensures that any changes you make to your plan are based on logic, objective data, and long-term performance rather than the temporary pain of a recent loss. This rule prevents strategy hopping and ensures that the sigma side of your brain is always the one in control when making executive decisions. The breakthrough. The signs of maturity. The breakthrough in trading does not arrive with the fanfare of a giant winning trade, the discovery of a secret indicator, or a sudden epiphany regarding the inner workings of the market. Instead, it arrives quietly, almost unnoticed, in the mundane moments of daily execution. You will know you are finally exiting the painful phase when trading starts to feel, for the first time, profoundly boring. In the beginning, you were addicted to the adrenaline of the gamble. You sought the cheap thrills of predicting the next move and the dopamine rush of being proven right. But as you mature, that excitement is replaced by the steady, quiet confidence of a professional. You have won the internal war when you can follow your rules perfectly, session after session, without the need for external validation. You take your stop losses without a hint of anger because you know they are simply the cost of doing business. You close your winning trades without the urge to tell anyone or brag on social media because your satisfaction comes from your discipline, not the dollar amount. Consistency in your behavior is the final and most important precursor to consistency in your bank account. When your actions become predictable, your results will follow. You have successfully traded the chaotic highs and lows of a gambler for the boring profits of a professional business owner. This is the Sigma Edge, the rare and powerful ability to do exactly what is necessary day after day while everyone else is still distracted by what is easy and exciting. You are no longer part of the 90% who chase the market. You are part of the elite few who operate within it. A Sigma Edge exclusive.